So you want to buy a home, but your credit isn't the best. That's okay. There still might be options available for you. Hi, everyone. My name's Courtney Thornell. Today, I'm going to talk about a topic that's important to a lot of you, how to buy a home if you have poor credit. Now, if you're worried about your credit score holding you back from owning a home, hopefully this video will help. So there are three common types of home loans: conventional, FHA, and VA. Now, with conventional, you will need a minimum 620 FICO score, but with FHA and VA, you can have a score as low as 500. Now, VA is a little bit more of a niche because you need to be a veteran, so FHA is the most common for lower credit borrowers. All right, first things first, what exactly is an FHA loan? The Federal Housing Administration loan, FHA, is a type of government-backed mortgage designed to make homeownership more accessible to lower income and first-time home buyers. Now, these loans are issued by the FHA-approved lenders, and they are insured by the FHA, which protects the lender in case there is a default. Now, this insurance, along with more flexible qualifying criteria, make it easier for lenders to offer these loans to borrowers with less than perfect credit. Now, when looking at your credit, you will get a report with scores from three credit bureaus: Experian, Equifax, and TransUnion. The lender is going to look at your mid-FICO score from the three reporting bureaus. For example, if you have one score at 620 and another score at 632 and the third one at 651, the score the lender will use is the middle score for qualifying purposes, which in this case is 632. Now, FICO score is a number that lenders do look at, but they also take into consideration the story of why your score is the number that it is. Your FICO score might be within qualifying guidelines, but a lender will look deeper into your credit history to take into consideration if you've had a recent bankruptcy or foreclosure, short sale, deed in lieu of foreclosure, collections, or missing payments. And that might keep you from qualifying for a home loan. So feel free to reach out, though, if you want more information on the FHA waiting periods for these types of credit events. All right, so the first step is to get pre-approved and make a plan. Let's analyze your credit and discuss whether now is a good time to buy and refinance later once you've worked on and raised your credit score, or if it's better to wait to make that purchase. Do the work now on your credit and put you in a better financial buying position a little later down the road. Now, I do often get asked, should I pay off all my debt now before I buy a home? And the answer is no, not necessarily. I want to take a look at your credit history and explore what payoff or paying down options would be beneficial and what options could actually harm your credit. For example, sometimes paying off a trade line such as a car or student loan might actually hurt your credit because you're closing that account. You are closing that trade line. Now, sometimes in order to qualify for a home, you might need to pay off a debt or a trade line, but in some cases, it might be best to pay it off at closing. Now, what does this mean? When you're at the end of escrow, when you are coming to the table with your funds, your down payment and your closing costs, that's when you will also supply the funds to pay off one or some of your debt. And the escrow company or the attorney, they will take care of making sure the payment gets to the creditor. Now, again, paying off debt and when to do it is something we should explore together, and then we can make a game plan. We can look into a long-term solution to get you in a better financial position and out of those high interest credit cards and get you to your financial goals. All right, so who qualifies for an FHA loan? Generally, FHA loans are available to anyone who meets the basic requirements, which include having a steady income, being able to afford the monthly mortgage payments, having a reasonable credit history. But let's break it down a little further. One of the main reasons FHA loans are popular is because of their lenient credit score requirements. And as mentioned, while conventional loans typically require a score of 620 or higher, FHA loans may accept scores as low as 500. Now, however, if your score is between 500 and 579, you will need to make at least a 10% down payment. If your score is 580 or higher, you may qualify with just a 3.5% down payment. Now, lower down payment options combined with more lenient credit requirements is what helped make homeownership a lot more accessible with the FHA loans. Now, circling back to down payment, more good news is that FHA loans allow you to use GIP funds towards your down payment and closing costs. Now, this can come from family members, employers, or approved down payment assistance programs. Now, down payment assistance programs can vary based on the state and county you live in. Now, a loan advisor will be able to help you see what's available in your area and what the qualifying guidelines are. All right, so next let's talk about the debt to income or DTI ratio. Your DTI ratio is a measure of all of your monthly debt payments, such as credit cards, student loans, auto loans, and that's compared to your monthly income. For example, if you have a car payment of $520 per month, a credit card payment of $80 per month, and another credit card payment of $25 per month. Before taking into consideration your future housing expenses, your current monthly liabilities total $625. Now let's say you make $5,500 per month. You would take the $625 in liabilities divided by the $5,500 in income, and your current debt to income ratio would be 11.63%. Now for FHA loans, the ideal DTI ratio is usually by up to 43%, but it could often go up to 50% with compensating factors such as a larger down payment or if you have significant cash reserves. So this means based off of the scenario we just did, you have 31.37% to 38.37%, which is $1,725 to $2,110 remaining in housing expenses. Now, something you have to take into consideration when factoring in your monthly payment is the principal and interest payment on the loan, but also taxes, homeowners insurance, mortgage insurance, and maybe possible homeowners association dues. Now, I know all these numbers might seem overwhelming, but I will break everything down for you during your pre-approval so there aren't any surprises. Now, one unique aspect of FHA loans is the mortgage insurance. Now, there are two types that are part of FHA loans. The upfront mortgage insurance premium, which is UFMIP, and the mortgage insurance premium, MIP. The UFMIP is typically 1.75% of the loan amount and is paid at closing, but more commonly, it's rolled into the loan. The MIP, on the other hand, is an annual premium paid monthly with your mortgage payment and can range anywhere from 0.45% to 1.05% of the loan amount, depending on the loan term and the loan to value ratio. Now, you will have both of these types of mortgage insurance, but these premiums are there to protect the lender, but unfortunately, they do add to the overall cost of the loan. So FHA loans do come with specific property requirements to ensure the home is safe and livable. The property must meet certain standards set by the FHA, which include being free and clear of hazards and major structural issues. Now, FHA loans can be used for various housing types, including single-family homes, multifamily homes, up to 4 units, condos and approved FHA projects, and some manufactured homes. So some common misconceptions are FHA loans are for first-time home buyers. Well, false. While they are popular with first-time home buyers, anyone who meets the requirements can apply. Another one, FHA loans are more expensive than conventional loans. Well, not necessarily. While FHA loans do have the ongoing mortgage insurance, they offer lower interest rates, which can help offset the cost. Another misconception, you need perfect credit for FHA loans. Well, hopefully from this video you've learned that that's not true. FHA loans are known for their more lenient credit requirements. All right, so there you have it. Don't let poor credit stand in the way of you buying a home if you're ready to make that jump into home ownership. If you're feeling overwhelmed by the process, remember you're not alone. As a mortgage loan officer, I'm here to help you navigate these waters and create a plan that works for you and your time frame. If you found this video helpful, please be sure to like, share, and subscribe to my channel for more tips on home buying and mortgage options. Now, if you have any questions or need personalized advice, leave a comment below or reach out to me directly through my contact information in the description. Thanks so much for watching. I'll see you next time.